Hello everyone, welcome to this edition of our Fund Insight series where we interact with our fund managers to understand their investment strategies and philosophies for the funds they are managing. I am Sonal Mittal, Product Specialist, and today we have with us Kamal Gada, Fund Manager of UTI Healthcare Fund, to share his insights on this one. So Kamal, can you throw some light on the investment strategy for UTI Healthcare Fund?
Thank you, Sonal, for having me here. UTI Healthcare Fund primarily focuses on investing in the companies engaged in pharma and healthcare space, as well as allied companies where revenues are mainly driven by pharma healthcare sector. The fund is market cap agnostic and invests in companies on a bottom-up basis with the potential to long-term growth. The allocation to a particular company would be primarily driven by the growth profile, management caliber, and the balance sheet strength. We also tactically invest in turnaround and cyclical opportunities for potentially outsized returns. Our investment philosophy revolves around UTI's score alpha model. We prioritize investments in top tier R1 companies with a proven track record of consistent growth and strong return ratios.
Well, what criteria do you use to select individual stocks for the portfolio?
Yeah, the allocation to a particular company would be primarily driven by the growth of that company, management caliber, and the balance sheet strength. So at the time of initiating coverage on the company, as well as while buying a company in the portfolio, the risk factors and its impact is given high importance. On a regular basis, we keep evaluating the risks and take necessary actions in the portfolio if necessary.
Kamal, viewers would like to understand, how do you ensure diversification within the healthcare fund?
The fund has exposure across various subsegments of the healthcare space, be it generics, Indian branded businesses, CDMO companies, pure play APIs, hospitals, diagnostics, as well as medical devices. So this ensures a kind of a diversification for our fund.
Okay. So how is your portfolio split between traditional pharma businesses, including generic exports, API, CDMO, and healthcare services? How has this changed over the years?
The traditional pharma plus generics would account for around 61 to 62% of the portfolio. CDMO would be around 13%, APIs would be around 3%, and healthcare services will be around 18 to 20%. Over last 1 year, we would have increased exposure to CDMOs, diagnostics, and APIs, and reduced traditional generic share.
Thank you for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.